Moving on to the next problems in capital budgeting. Actually, we solved in introductory part of the video. We have solved one question, that is problem number 13. That is basic idea about all the topics. That is payback period, rate of return on original investment, and what is ARR, what is NPV, what is profitability index, and what is IRR. On all the different capital budgeting techniques, we had solved in single problem. So moving on to the next problem. So one by one we'll be solving the same kind of concepts, whereas you will be having a new additional technique. That is, you'll be having you'll be solving different kind of options, evaluating the better option, all those formula, like whatever you have done in the problem number 13, it will be the same. The method of calculating the capital budgeting techniques will be the same, but you have to apply it in the different options so that you can evaluate the options, or they'll give a project whether NPV is positive or negative, you should find. So this is how this capital budgeting chapter will be. So moving on to the next problem, that is problem number 12. P Limited is considering two mutually exclusive projects. So mutually exclusive projects means two different projects, both require an initial cash outlay of 10,000 rupees. So both the options require initial cash outlay of 10,000 rupees. So cash flow out that happens at the today, like cash flow which has been done, cash outflow which has been expended today is 10,000 rupees. So 10,000 into 1, so present value of the 10,000 is 10,000, and 10,000 each for machinery and have a life of 5 years. So machinery life is 5 years. The company requires a rate of return, company required rate of return is 10% and it pays 50% tax. Okay, the company's required rate of return is 10%. So cost of capital should be taken as 10%. The projects will be depreciated on straight line basis. So 10,000 is the cost of machinery, and it will be depreciated on straight line basis. So 10,000 divided by 5, that is, for every year 2,000 rupees is depreciation. The net cash flows before tax expected to be generated by the projects and the present value factor at the rate of 10% are as follows. So below that in the table, what they have given, no, they have given what is the cash inflow for every year for 5 years for project 1 and project 2, which are two projects which are mutually exclusive projects. So project 1, every year it is 4,000 cash flow after tax. Not, it is not cash flow after tax, net cash flows before tax. So this is the tax which is coming in before tax. On that, for project 2, there are every year it is different, like net profit before tax is different for every year for project 2. And PV factor, see here, they have given that PV factor is 10%. They didn't ask us to find it using table and all. They have directly given what is the PV factor at the rate of 10% for first year, second year, third year, fourth year, and fifth year. So from this itself, you can directly take and multiply it. From this, you are required to calculate payback period of each project. So how you can find the payback period? Initial investment divided by CFAT, annual CFAT. If suppose annual CFAT is different every year, then you should find the cumulative CFAT and find what is the payback period. And second, they have asked us to calculate NPV and the profitability index. So NPV, how will you calculate? You will calculate what is CFAT. CFAT into PV factor at the rate of 10%, you will get what is the net present value. From that, if you deduct net present value of cash inflow minus present value of cash outflow, you will get what is NPV. So next is profitability index they have asked. Profitability index is nothing but present value of cash inflow divided by present value of cash outflow. So that is the problem number 12 which they have asked. So like how we did in previous sum, same concept, same steps, we can solve this problem number 12. So come to the notes. Take down problem number 12. Below that problem number 12, statement number 1, calculation of annual CFAT, that is year C. CFAT for project 1 for every year, that is the net cash inflows before tax for every year is same for project 1. Then you can find it using only one value, that is 4,000 itself. If every value is different, then you should go for every 5 years, that is each year you should calculate what is CFAT. Whereas if every year the amount is same, that is if net profit is same every year, then you can find using only one number, that is 4,000. Okay, below that, two columnar table. Statement number 1, calculation of average CFAT of project 1. calculation of, actually it is annual CFAT, calculation of annual CFAT of project 1. Below the 2 columnar table, first column particular, second column amount, first column particular, second column amount. Below that particular small a, net cash flows before tax, net cash flows before tax. In respect of amount column, how much is the net cash flows before tax? They are given net cash flows before tax, so 4,000. In respect of amount column, record 4,000. See, they have given net cash flows before tax. You just understand this concept. Always net cash flows before tax will be calculated after deducting depreciation. Okay, understand? Net cash flows before tax is nothing but profit before tax, PBT. PBT is always calculated after deducting the depreciation from the PBDIT. See, simple man. PBDIT means profit before depreciation, interest and tax. From that, first you will deduct depreciation. Then it will become PBIT, which is meant by EBIT, earnings before interest and tax. From that, if you deduct interest, you will get what is EBT. EBT is nothing but PBT, profit before tax. Here they have given what is profit, net cash flows before tax. So you have already deducted what is interest and what is depreciation. So after deducting both interest and depreciation, what you will deduct from the PBT? You will deduct tax. Below that, small b, less tax at the rate of 50%. They are given tax percentage as 50%. So tax, less tax at the rate of 50%. Amount column record 2,000 within bracket. So 4,000 into 50%, how much is it? 2,000 within bracket 2,000. Now amount column total it. Amount column total it. You are getting 2,000. Below that record 2,000. In respect of the 2,000, record small c, profit after tax. Profit after tax. See, profit before tax minus tax, you will get profit after tax. On that profit after tax, if you add depreciation, which is a non-cash expense, so if you add it back to the profit after tax, you will get what is cash flow after tax. You will get what is cash flow after tax. So 2,000 plus 2,000, you are getting 4,000. 2,000 plus 2,000, you are getting CFAT 4,000. So net cash flows before tax minus tax at the rate of 50%, you will get profit after tax. So profit after tax plus non-cash expenses, that is depreciation, you should add it back. You will get CFAT. So CFAT for project 1 is nothing but 4,000 rupees. So CFAT for project 1 is 4,000 rupees. Below that, so now we have found what is CFAT. If you divide initial investment of 10,000 divided by CFAT, you will get what is the payback period. So we'll just calculate what is the CFAT for project 2, then we'll move on to payback period. So below that, statement number 2, calculation of annual CFAT of project 2. Calculation of annual CFAT of project 2. Annual CFAT of project 2. Below that, 6 columnar table. Below that 6 columnar table, first column particulars, second column year 1, third column year 2, fourth column year 3, fifth column year 4, and last column year 5. Particulars year 1, year 2, year 3, year 4, and year 5. So below that particulars, same format. Small a, what is PBT given here? Profit before tax, 6,000, 3,000. This net cash flow before tax is nothing but profit before tax. So project 2, take down. Year 1, 6,000. Year 2, 3,000. Year 3, 2,000. Year 4, 5,000. And year 5 also 5,000. So that is the profit before tax for each year. Below that, small b less, tax at the rate of 50%. Tax at the rate of 50% in respect of year 1. See, tax is 50%. On PBT, we should calculate 50%. So 6,000 into 50%, you are getting 3,000 within bracket. 3,000 within bracket. And 3,000 into 50%, you are getting 1,500 within bracket. 1,500 within bracket. And year 3, 2,000 into 50%, you are getting 1,000 within bracket. 1,000 within bracket. Year 4, 5,000 into 50%, you are getting 2,500 within bracket. And last year also 5,000 into 50%, you are getting 2,500 into within bracket. So what is the total? What is the tax amounts for year 1? It is 3,000. Year 2, 1,500. Year 3, 1,000. Year 4, 2,500, and year 5, 2,500. So now deduct it. Below that, small c, profit after tax. Profit after tax within bracket A minus B. Profit after tax within bracket A minus B. For year 1 record 3000, 6000 minus 3000, you are getting 3000. Year 2, 1500. Year 3, 1000. Profit after tax for year 3, 1000. And for year 4, 2500. And for year 5 also 2500. So this is the profit after tax. On this profit after tax, if you add back depreciation, you will get CFAT. So what is the depreciation? See, total amount is 10,000 divided by 5. You are getting 2,000 rupees every year as depreciation. So add back 2,000 to every year. Below that small d, add depreciation because they are given straight line basis. So straight line basis is nothing but total cost of the machinery divided by life of the machinery. So 10,000 divided, there is no scrap value given. If some scrap value is given, suppose 1,000 rupees is scrap value, then 10,000 minus 1,000 divided by 5. Here scrap value is 0. They are not given any scrap value. So 10,000 divided by 5, you are getting 2,000. So every year record 2,000. Add depreciation, every year record 2,000. Now below that, small e, CFAT. CFAT, that is cash flow after tax within bracket profit after tax plus depreciation, that is C plus D within bracket C plus D. Why are you adding depreciation? Is depreciation is a non-cash expenses. You have deducted it from the profit, whereas depreciation you are not spending any, you are not expending any amount. It is just a non-cash expenses which you are deducting from the profits. So you are adding it back to the profit after tax in order to find what is the total cash coming in. So below that small e CFAT within bracket C plus D. Now add it. 3,000 plus 2,000, you are getting 5,000. 1,500 plus 2,000, you are getting 3,500. 1,000 plus 2,000, you are getting 2,000. 3,000. 2,500 plus 2,000, you are getting year 4, 4,500. And for year 5, 2,500 plus 2,000, you are getting 4,500. For year 5 also 4,500. So that is a CFAT for project 2. So with that, we have found what is the CFAT for project 1 and project 2. Now moving on to payback period. So statement number 3. Below that statement number 3, calculation of payback period of projects. Calculation of payback period of projects. Below that, small Roman number 1, project 1. Below that, small Roman number 1, project 1 is equal to, what is the formula for payback period? Initial investment divided by annual CFAT. So is equal to, project 1 is equal to initial investment divided by annual CFAT. Annual CFAT. Below that is equal to, what is the initial investment here? 10,000. And what is the annual CFAT we find for the first project? That is 4,000. So below that is equal to 10,000 divided by 4,000. 10,000 divided by 4,000, you are getting 2.5 years is equal to 2.5 years. So project 1, 2.5 years. Below that, we have, so now payback period for project 1 is 2.5 years, because every year the cash flow after tax is same, that is 4,000. You are directly dividing it from the initial investment. You are getting what is the payback period for project 1. So now calculate for project 2. Below that, small Roman number 2, hyphen project 2, underline it. Project 2, underline it. Below the 3 columnar table. Below the 3 columnar table, first column year, second column CFAT, third column cumulative CFAT. Year CFAT, third column cumulative CFAT. Below that years record 1, 2, 3, 4, 5. Below that years record 1 by 1. 1 first year, second year, third year, fourth year, and fifth year. And in respect of each year record what is the CFAT. We have calculated what is the CFAT in the statement number 2 for the project 2. So copy it. For the year 1 it is 5,000. For year 2 3,500. For year 3 3,000. For year 4 4,500. And for year 5 4,500. So we have copied all the CFATs. How did we find the CFAT? Just PBT minus tax, you are getting profit after tax. On that, if you add depreciation, you are getting CFAT. So you are copying the CFAT here in project 2 for calculating the payback period. For payback period for NPV, you should always use what is CFAT. You should not use profit after tax. So CFAT we calculated. Now in respect of cumulative CFAT, how to calculate cumulative CFAT? We saw in previous problem itself. For year 1, what is CFAT? Same will be the cumulative CFAT. And for year 2, year 1 cumulative CFAT plus year 2 CFAT. You will get year 2 cumulative CFAT. So here record 5,000 is the year 1 CFAT. So that will be the cumulative CFAT also. So record in respect of year 1 cumulative CFAT, record 5,000. Cumulative CFAT for year 1 is 5,000, and for year 2 what is cumulative CFAT? Year 1 cumulative CFAT plus year 2 CFAT, 5,000 plus 3,500, you are getting 8,500. So year 2 cumulative CFAT is 8,500. 8,500. Now for what is the cumulative CFAT of year 3? Year 2 cumulative CFAT 8,500 plus year 3 CFAT, that is 3,000. So add both 8,500 plus 3,000, you are getting 11,500, whereas the project investment is only 10,000. So underline it. In respect of second year CFAT, just underline it. So your payback period for project 2 is in between second year and the third year. So we should calculate using the formula, that is payback period formula, so that we will arrive at what is the payback period. So below that payback period is equal to, so what is the lower year? That is second year. So 2 plus what is the short of investment? Short of investment is nothing but here 8,500 has been received at the end of second year. So what is the remaining investment required? 10,000 minus 8,500. You want 1,500 in the next year. So 2 plus, just take down the formula first. Short of investment divided by CFAT of the higher end year, that is third year. The second year is considered as lower end year. This third year is considered as higher end year because the payback period is falling in between second year and the third year. So CFAT of the third year. Below that is equal to 2 plus, how much is the sort of investment? 10,000 minus 8,500 has been already received before second year. So remaining 1,500, 2 plus 1,500 divided by what is the third year CFAT? 3,000. 1,500 divided by 3,000. You are getting 0.5. So below that is equal to 2.5 years. 2 plus 0.5, you are getting 2.5 years. Is equal to 2.5 years. So payback period for the year 1, project 1 also 2.5 years, and project 2 also 2.5 years. If they ask you to comment on best option, then this payback period for both the project are similar, so it is indifferent. So next, with that we have calculated payback period. See, simple concept for payback period, only this you should remember. If annual CFAT for all the years we have calculated is similar, means then formula should be for payback period initial investment divided by annual CFAT. Whereas if annual CFAT which we calculated, if it is different for all 5 years, then calculate what is the cumulative CFAT and use this formula, that is lower end year plus short of investment divided by CFAT of the higher end year. You will get what is the payback period. That's all. So next, what they are asking, calculate the NPV and the profitability index of the project. Okay, here they have given cost of capital, that is return on investment is 10%, that is to be considered as cost of capital. And also we don't want to see the table. Here they have directly given what is the PV factors, present value factors for 10% for every year they have already given. So we don't have to go check what is the present value factors at 10% for every year. We can just copy it from here itself. So below that statement number 4, calculation of NPV and profitability index. Calculation of NPV and profitability index. Below that, capital A, project 1, underline it. Below that, capital A, project 1, underline it. Below that, project 1, record 4 columnar table. First column year, second column CFAT, third column PV factor, and fourth column PV. See, you can do 2 options here. Okay, 2 things you can do here. I'll explain you both the options so that it will be easy for you to save time. First method is calculating year by year. If like for every net present value calculations, you should go year by year. Whereas if CFAT is same for all the years, that is for all the years CFAT is same 4,000 in this particular thing, then you can multiply 4,000 into what is the annuity factor at 10% for the 5 years. Just see what is the annuity factor for 10% of the 5 years. See, annuity factor for 10% for 5 years is 10%. Annuity factor means summation of all 1 by 1 year. That is first year value, second year plus second year value, third year first year, second year plus third year value. That is called annuity factor. So for 10%, what is the 5 years? 3.791. So just multiply 4,000 into 3.791. You are getting 15,164. 4,000 into which is nothing but 15,000. They have written 15,160, but here 15,164. So 4 rupees, round it off, 15,160 they have taken. So if you multiply one by one, 4,000 into 0.901, 4,000 into 0.826, which PV factors, if you multiply with the PV factors, you will get the same 15,160. Whereas if you multiply 4,000 with the annuity factor for 5 years, you will get same 15,160. But the criteria is for CFAT, all the years it should be the same. If all the years it is same, you can directly multiply what is the annual CFAT into annuity factor at the rate of 10% for 5 years. Annuity factor at the rate of 10%. Annuity factor at the rate of 10% for 5 years, 3.791. Here 3.791 into 4,000 if you do, you are getting 15,160. If you deduct 15,160 minus 10,000 initial investment, you will get 5,160, which is the net present value. Both the methods you can do. Okay. Just to have a clarity, I told you here, instead of going one by one, suppose here it is time consuming. CFAT 4,000 into 0.909, one value. 4,000 into 0.826, then it will come one value. So you should add all the values. Then you will get 15,160. Instead of doing that, if CFAT for all the years are same, just multiply with the annuity factor for the same number of year at the 10%. So you will get the 3.791. If you multiply with 4,000, same amount you will get. So take down now. Below that 4 columnar table, first column particulars, second column first column years, second column CFAT, year CFAT, third column PV factor at the rate of 10%, PV factor at 10%, fourth column PV. In respect of CFAT, within bracket record A, small a, and in below PV factor at 10% records within bracket small b. CFAT small a and PV factor at the rate of 10% small b. In respect of last column, that is present value, within bracket record A into B. A into B. A into B. Now below that years, record one by one. First year, second year, third year, fourth year, fifth year. Total 5 years. Record all 5 years. 1, 2, 3, 4, 5. In respect of all the years, record CFAT 4,000, 4,000, 4,000, 4,000, and 4,000. So CFAT for all the years which we found using the formula, that is PBT minus tax, that is PAT plus depreciation, will get CFAT. Using that formula, we found what is CFAT. So CFAT for all the years will be 4,000. And next, PV factor at the rate of 10%. They have directly given in the question itself. What is PV factor? So PV factor at the rate of 10%. First year record 0.909. Second year 0.826. First year 0.909. Second year 0.826. Third year 0.751. Fourth year 0.683. Fifth year 0.621. 0.909, 0.826, 0.751, 0.683, 0.621. So now multiply it. Now calculate what is the present value factors, present values. So first year 4,000 into 0.909, you are getting 3636, 3,636. In respect of present value column, record 3,636. And year 2, 4,000 into 0.826, you are getting 3304. In respect of present value column, record second year 3304. Third year 4,000 into 0.751. 4,000 into 0.751. In respect of present value column, record 3,000. In respect of present value column, record 3,000. Fourth year 4,000 into 0.683. You are getting 2,732. 2,732. In respect of fourth year present value column, record 2,732. And last year 4,000 into 0.621, you are getting 2,484, that is 2,484. 2,484. Now present value column, total it. Present value column, all 5 years, total it. Underline it. Below that record 15,160. 15,160. In respect of that 50, don't total this 3.779 and all. Don't take anything in this. Just in respect of 15,160 record present value of cash inflow. In respect of this 15,160 record present value of cash inflow. Present value of cash inflow. Below that less present value of cash outflow. Present value of cash outflow How much is the total cash outflow? Only at the beginning of the year he has spent 10,000 rupees for machinery. After that there is no expenses. So 10,000 into, if at the beginning of the year he is spending, then it is 10, present value factor will be 1. So 10,000 within bracket 10,000 into 1, present value of cash outflow within bracket 10,000 into 1, present value column, record it below that 15,160, 10,000 within bracket, 10,000 within bracket. Now total it, 15,160 minus 10,000, you are getting 5,160. 5,160. So in respect of that 5,160, record net present value. Net present value. Net present value. So we have found what is net present value for the year project 1. And below that record profitability index for project. Profitability index within bracket project 1 is equal to, within bracket project 1 is equal to, take down the formula, present value of cash inflow divided by present value of cash outflow. Present value of cash inflow divided by present value of cash outflow. So what is the present value of cash inflow which we found in the project 1? 15,160, and cash outflow is 10,000. So divide that, is equal to 15,160 divided by 10,000. 15,160 divided by 10,000 is equal to, you are getting 1.516. 1.516. So that is the profitability index for project 1. So with that we have completed what is the NPV and the profitability index for project 1. Below that capital B. Below that capital B, project 2, capital B project 2. Underline it. Underline project 2. Below the project 2 record 4 columnar table. First column year. First column year. Second column CFAT. Third column present value factor at the rate of 10%. See, year CFAT, last column present value. Year CFAT present value factor at the rate of 10% and present value. Here you can't take same value and multiply with the annuity factor, because here CFAT for each year is different. So you have to go with this method only. That is, you have to method each year CFAT with the each year present value factor, so that you will get different present values for every year. Summation of it, you will get what is the present value of cash inflow. From that, if you deduct present value of cash outflow, you will get net present value. So now record it. Below that years, record year 1, year 2, 3, 4 and 5. Record all 5 years. 1, 2, 3, 4 and 5. In respect of each year, record what is the CFAT. So what is the CFAT which we found in the statement number 2 for project 2? For year 1 it is 5,000. In respect of CFAT column, record year 1 5,000, year 2 3,500, year 3 3,000, year 4 4,500 and year 5 also 4,500. 5,000, 3,500, 3,000, 4,500 and 4,500 for all 5 years CFAT. Now take down what is present value factor at the rate of 10%. Present value factors at the rate of 10%. Now copy it from the question itself. They have directly given what is present value factors at the rate of 10% for each year. For first year 0.909. In respect of present value factors at the rate of 10%. Year 1 0.909. Year 2 0.826. Year 3 0.751. Year 4 0.683. And year 5 0.621. That is the present value factors at the rate of 10% for each year. That is up to 5 years. So multiply CFAT and PV factor, you will get what is present values. So multiply it. For year 1, 5,000 into 0.909. 5,000 into 0.909. You are getting 4545. That is 4,545. 4,545. For year 2, 3,500 into 0.826. 3,500 into 0.826, you are getting 2,891. 2,891. Below that year 3, 3,000 into 0.751. 3,000 into 0.751, you are getting 2257. 2253. 2253. Present value column year 3 record 2,253. And for the fourth year, 4,500 into 0.683. 4,500 into 0.683. You are getting 3,074. 3,074. And last year 4,500 into 0.621. You are getting 2,794. 2,794. You are adjusting this 0.5 with the fourth year 0.5. So fourth year you are adding 0.5 and fifth year you are not adding the 0.5. So now total all the present values. If you total all the present values, total it, use the calculator and total it, you are getting 15,557. 15,557. In respect of that 15,557, record present value of cash inflow. Present value of cash inflow. Below that, less present value of cash outflow. Present value of cash outflow. See, what is the only cash outflow that has been incurred? 10,000 rupees at the beginning of the year for purchase of machinery. After that, there is no cash outflow given. So next to the present value of cash outflow, within bracket record 10,000 into 1. 10,000 into 1. In respect of present value column, record 10,000 within bracket. 10,000 within bracket. Now total it. 15,557 minus 10,000. 15,557 minus 10,000, you are getting 5,557. 5,557. In respect of that 5,557, record net present value. In respect of that 5,557, record net present value. Net present value. So we have found what is the net present value for the project 2. Now if you divide both cash inflow divided by cash outflow, you will get what is profitability index. So below that, leave one line gap, record profitability index within bracket project 2. Profitability index within bracket project 2 is equal to present value of cash inflow divided by present value of cash outflow. Present value of cash inflow divided by present value of cash outflow. And one more important key point is, for every sum which you are doing, always keep writing the formulas. Don't do the calculation directly. Write the formula, then calculate it, so that you won't forget the formula. And one more thing is, in exams also you should write the formula, then only you should calculate it. You should not take what is the present value of cash inflow directly and write it next to profitability index. Write the formula, then calculate the answer. So present value of cash inflow divided by present value of cash outflow. How much is the present value of cash inflow? 15,557 divided by 10,000. 15,557 divided by 10,000, you are getting 1.5557, which is nothing but 1.56, which is equal to 1.56. So profitability index is 1.56. See, profitability net present value and the profitability index of project 2 is 5557 and 1.56, whereas for project 1 is 1.516. So for profitability index for project 1 is lesser than project 2. So project 2 is acceptable. And NPV is also, NPV, how much is NPV for the project 1? 5,160. Whereas for project 2, 5,557. So both profitability index and net present value are higher for project 2. So below that comment, take down net present value and profitability index. Net present value of profitability index of project 2 is comparatively higher. Net present value and profitability index of project 2 is comparatively higher, and hence it is advisable to the entity, to select project 2, and hence it is advisable to the entity to select project 2. See, if you are not taking notes for this capital budgeting, if you are just watching the video, I can damn sure give 100% that you can't make it in exam. Capital budgeting only by working out, because in this FM only this capital budgeting is the only chapter which takes time. Capital budgeting will take time, and one more thing which takes time is this working a cash flow statement. So both this will take lot of time, but what you have to do is both cash flow statement and this capital budgeting, without working you can't make it. So you have recorded comment. So project 2 is preferable. So with that we have completed problem number 12. So moving on to the next problem, that is problem number 10. Moving on to the next problem, problem number 10. Come to problem number 10. See, here in problem number 10, very simple. They have given all the data. There is no data missing. They are just asking us to advise the investor to select the project. So you being an CFO of a particular company, in your company, there are two projects, project A and project B, and you are going to comment on which project is best for the investor. That is, for a company, which project we should select. So that is what you are going to comment using this data. So we can give relevant comments on this data by saying investment is 7 crore and 5 crore. So basically there are two different investments. So NPV we should not take into consideration. That is, when there are two different investment and project life is 2 different years, they are mutually exclusive projects. So NPV cannot be used as a criteria to select the project. Next is the cost of capital 15% and 18% and IRR 45%. So IRR is basically more in project A and rate of return is more in project B. Whereas BEP is 45% for project A and for project B it is 30%. So comparatively, project B is acceptable if you are going with BEP, and profitability index is comparatively more for project A. So we should comment on this which project is acceptable. So problem number 10, take down. Problem number 10, record. Basically, what they have given in the question, project A and B are analyzed and you have to determine the following parameters. You have determined the following parameters, advise the investor on choice of the project. So problem number 10, take down below that point number 1. Always remember this. When there is life disparity, take down point number 1. Point number 1, take down. When there is life disparity, disparity means when there is life difference in period of life. When there is life disparity, comma, then NPV is not suitable criteria. Then NPV is not suitable criteria to evaluate mutually exclusive projects. So when there is life disparity, the NPV is not the suitable criteria to evaluate mutually exclusive projects. So here, see, in the question they have clearly given project life for project A is 8 years, man, and project B is 10 years. When there is life disparity, that is, if both are 10 years, then you can compare it using this NPV factor. But here, life of both the projects is different. So you cannot use net present value in order to evaluate which project is best. Just remember this. When there is life disparity, when there are two different projects with having two different project life, then you cannot compare those projects using NPV method. That's all. That is one point you should remember. Why you can't compare is you are converting all the cash flows into present cash flows, whether it is outflow or inflow, you are converting into present. So here project A, it is getting hindered at the end of 8 years itself. So project A lifetime is only 8 years. So if you compare project A with the project B, which has 10 years, definitely there will be excess cash inflow or cash outflow in the 9th and 10th year. So you cannot compare project B with the project A because of the life difference. The period of life is different, project life. So you cannot compare using NPV. So that is point number 1. So below that, point number 2. Again, when there is investment disparity, comma, then ARR, that is accounting rate of return, then ARR is not suitable criteria to evaluate mutually exclusive projects. See, when investment goes higher, your return percentage also will be higher because you are going to invest a lot of amount. The return which you are going to expect is also more. See, simple man, I'll give you a small example. Suppose you have two options. One option is to invest in land, and other option is to purchase stock. Okay, both the options having different investment. So that in option 1, that is purchasing land. If you for purchasing land, you might purchase a land only by spending a lot of amount. And also one more point is you can expect a long-term investment. You can expect it to be a long-term investment. Whereas if you are investing in stock, you cannot define it as a long-term investment or short-term investment because it may fluctuate based on the market. So that comparing two different investments which have different amount of investment. That is, the amount of investment is, if for two projects are different, you cannot compare it using ARR, which means accounting rate of return. So accounting rate of return is nothing but return which is expected from the as a profit from the amount invested. What is the formula for accounting rate of return? Average profit after tax divided by initial investment, that is net investment or initial investment, into 100. So whatever your whatever is your profit expectations, to that if you divide the investment amount, you'll get what is ARR. So you cannot compare two ARR, that is you cannot compare two different projects having different investments. So that is point number 2. So when there is investment disparity, then ARR is not suitable criteria. ARR is not suitable criteria to evaluate mutually exclusive projects. To evaluate mutually exclusive projects. So how can you compare this both the projects then? You can compare this both the projects by IRR, payback period, and profitability index. Here rate of return you can't compare because ARR two different investments, so ARR you can't compare. NPV, both NPV at 12% and 18% you can't take into consideration because two different project life. So remaining is IRR is there, payback period is there, profitability index, and BEP is also there. See, BEP, you can compare BEP only if, see, for BEP also only if there is same amount of investment, then you can compare BEP. BEP you can't compare if there is two different investments, and also because of two different investments, profit may vary. So profit may vary, so accordingly BEP and margin of safety may also vary. So BEP you cannot compare. So you can only compare using three things here: IRR, internal rate of return, then payback period, then profitability index. So below that, statement number 3, evaluation of project 1 using the criterias. Evaluation of projects using other criterias. Evaluation of projects using other criteria. Below that, 3 columnar table. First column particulars, second column project A, and third column project B, and third column project B. Below that particulars, IRR, which is higher, only if it is higher it is acceptable. Your internal rate of return for project A is 45%, for project B is 32% only. So in respect of project A column, record Roman number 1, and in respect of project B, record Roman number 2, because project A is having higher IRR whereas project B is having lower IRR. So project 1 is option 1 and project 2 is the option 2 if you go with IRR. You go with IRR. Below that, payback period. Below that, payback period. See, payback period is 4 years for project A, whereas for project B 6 years. What is mean by payback? Within how many years you are taking back your investment? That is, whatever the investment you have put in, within how many years you are taking back that investment from the profits. So that is, for project A, within 4 years you are taking back all your investment amount, whereas for project B it takes 6 years to take back your investment amount itself. So comparatively project A is option, comparatively project A is preferable. So in respect of that payback period, project A record statement Roman number 1, and project B record Roman number 2. So comparatively project 1 is acceptable if you go with payback period. So next, last is profitability index. Below that payback period, record profitability index. So profitability index for project A is 1.76 and project B is 1.35. So comparatively, project A has more profitability index. Whichever option has more profitability index, that is acceptable, because you are having more number of cash inflows compared to the cash outflows. So what is the formula for profitability index? Cash inflow divided by cash outflow. Present value of cash inflow divided by present value of cash outflow. Where the profitability index is more, that option is preferable. Here project A has more profitability index, so it is preferable. So project A in respect of profitability index, record Roman number 1, and project B record Roman number 2. So analyzing all 3 factors, you are seeing that project A is preferable under all 3 options. Under all 3 different techniques, project A is preferable. So below that comment, record comment. All criterias are favoring project A. All criterias are favoring project A, and hence it is advisable to select project A. So that is problem number 10. With that we have completed problem number 10. Moving on to next problem, that is problem number 9. Moving on to next problem, that is problem number 9. So simple, this problem number 10, what they have asked, they have just asked us to comment. You can expect this sum also in exam for 4 marks or something. So you should know that the main concept for doing this problem, one, if there is some life disparity, that is if there is difference in project life, you cannot compare the projects using NPV. And see, suppose I'll give you a situation. Okay, there was in one attempt they gave a data. Okay, all those data, whatever is the cash inflow, whatever the PBT, tax rate, everything, they gave the question. They asked us to select which project is preferable. They have given 2 projects and they asked us to select which project is preferable. If they have given 2 different projects and if their lifetime is different, if the project life for both the projects are different, then you should not use NPV. If you are using NPV, there full sum is wrong. So why they have given this separate sum, that is problem number 10. So when there is 2 different project life, you cannot do problem using NPV. Only if they mention by giving 2 different project life. Suppose in a particular sum they gave in exam, they gave different project life, and below that they have given evaluate using NPV method. Then you can do NPV method. But if they just tell you to analyze which project is preferable without giving any technique, which technique to use, then if there is 2 different project life, you should not use NPV method. And if there is 2 different investments for 2 different projects, then you should not use ARR. So that is why they have given this problem number 10 to make you understand that if there is 2 different project life, you cannot use NPV method. That is point number 1. And if there is 2 different investment size, you cannot use rate of return, that is ARR method. So these are the 2 important points which they have told in this problem number 10. So you should understand it. When they give a question telling calculate select which project is preferable, just advise on which project is preferable if they give question. And if there is 2 projects and 2 projects investments are different, always don't use ARR to evaluate the projects. And if 2 projects project life is different, don't use NPV to evaluate the projects. You can go with IRR, or you can go with some other criteria. You can even go with profitability index. You can go with payback period, but don't go with NPV method if there is 2 project life. So that is why they have given this problem number 10. Just mark this problem number 10 important. Just remember that 2 key points. So next, moving on to problem number 9. Following are the data on capital project being evaluated by the Management X Limited. Okay, for Management X Limited, there is a capital project data which is being evaluated, and they have given few datas. Using the datas, we have to fill other datas. That is, what is the NPV, what is the cost of capital, what is the cost of project, and what is the payback period. All these things we have to evaluate using this data they have given. So that is the question given. We have to fill the remaining places in the data. Below that, find the missing values considering the following table of discounted factor. So you don't have to go to the present value factor table. They have given the present value for 15%, 14%, 13%, and 12% for all 4 years. And also they have given annuity factor for 15% for 4 years, that is 2.855. Annuity factor for 14% for 4 years, that is 2.913. So all those data they have given. This PV present value factor and the annuity factor they have given for all 4 percentages for all 4 years. So using this, you have to evaluate what is the NPV, what is the cost of capital, what is the cost of project, and payback period. So it is very simple. You have to use all the formulas to calculate what is the different missing numbers. Okay, done. With that, moving on to solution. Come to the notes. Please take down the notes. Don't just watch the video. Take down the notes. This and all, like when you work out only, you will remember. So below that problem number 9, below that sum, next is sum. Put the heading problem number 9. Statement number 1. First we are calculating cost of project. Cost of project. Statement number 1. Calculation of cost of project. Calculation of cost of project. See, remember this. At IRR, that is internal rate of return, both present value of cash inflow will be equal to present value of cash outflows. Remember that. At IRR, present value of cash inflows will be equal to present value of cash outflows, because IRR is calculated using discounted cash inflows. Yesterday we did this IRR problem. How did we do? We computed what is the discounted present value factor at the lower end and at the higher end. Then we calculated what is the percentage of IRR. So basically for this IRR, what are we doing? We are calculating the present value of cash inflows. From that you are deducting the present value of cash outflows. Then you are getting what is net present value. Then two different net present value you are comparing and you are arriving at IRR. So this is method of calculating IRR. So for method of calculating IRR, you are using present value factors and you are using present values. So ultimately at IRR, present value of cash inflows will be equal to present value of cash outflows. Just remember that at IRR, whatever the present value of cash inflow will be equal to present value of cash outflow. Okay, done. Below the statement number 1, record point number 1. At IRR, comma, present value of cash inflow will be exactly equivalent to present value of cash outflows. Why? Because we are using present value factors to calculate what is IRR. So when we are using present value factors, you are bringing all the values, all the different years values to the present value, present day value. So the present value of cash inflow will always be equal to present value of cash outflow. So below that, point number 2. So ultimately what they are telling, present value of cash inflow at IRR is equal to present value of cash outflow. So see here, present value of cash inflow at IRR and the present value of cash outflow as total will be same. So below that, point number 2, present value of cash inflow at IRR, is equal to present value of cash outflow, Here they are given IRR is 15%. So we can easily calculate what is the present value of cash inflow at IRR. So below that, first take down the formula. Present value of cash inflow at IRR is equal to present value of cash outflow. And below that, what is the present value of cash inflow at IRR? Normally what you will do to calculate IRR? Annual CFAT. Here annual CFAT is same for every year. So annual CFAT into what is the IRR rate? 15%. What is the life of the project? 4 years. So 15% annuity factor for 4 years, you will get what is the present value of cash inflow at IRR. Below that, take down annual CFAT into annuity factor at the rate of 15% into annuity factor at the rate of 15%, which is nothing but present value of cash inflow at IRR is equal to present value of cash outflow. Simple, man. I will tell you one more thing about IRR. IRR, why we are calculating is internal rate of return. We are just calculating within which period, at what percentage we are taking back our investment. So present value of cash outflow is nothing but how much we are expending. So that is the amount which we are calculating at IRR. So how we are calculating that? We are using the discounted cash inflows and converting into the present day's value, so that the total amount of cash outflow within which period we are getting and at what percentage we are getting. That is what we are calculating using IRR. So here annual CFAT into annuity factor at the rate of 15% is equal to present value of cash outflow. What is the annual CFAT? Annual cost saving. That is annual CFAT, cash flow after tax. That is 40,000 rupees. So 40,000 into annuity factor at the rate of 15% for 4 years. Here they have given IRR is 15%. Useful life is 4 years. So 15% for 4 years. What is the annuity factor? They have given 2.855. That is summation of all 4 years. So 2.855, 40,000 into 2.855 is equal to present value of cash outflow. So if you multiply this both, you will get what is the present value of cash outflow. So that is the cost of the project. Simple. whatever is the present value of cash outflow, that is the cost of the project. So multiply it. Present value of cash inflow is 40,000 into 2.855. You are getting 1,14,200. Present value of cash outflow is equal to present value of cash outflow is equal to 1,14,200. 1,14,200. Below that, cost of the project is equal to whatever is the present value of cash outflow, that is the cost of the project. We are assuming that the entire cost outflow for the particular project is expended on the first day, that is today itself. So we are assuming present value of cash outflow is cost of the project. So cost of the project is equal to 1,14,200. 1,14,200. Simple. Use the IRR method. What is the formula for IRR? We are calculating IRR using discounted cash flows. So formula for IRR is nothing but present value of cash inflow at IRR is equal to simply at IRR present value of cash inflow will be equal to present value of cash outflow. So here present value of cash inflow at IRR is nothing but annual CFAT into an annuity factor at the rate of what is the IRR percentage. Here IRR percentage is 15. So annuity factor at the rate of 15% for 4 years. If you multiply it with the annual cash flow after tax, you will get what is the present value of cash inflow at IRR, which is equal to present value of cash outflow. So present value of cash outflow is 1,14,200, which we found. So that is nothing but cost of the project. So that is the amount you are expending for the project. So that is called cost of the project. So with that we have found what is the cost of the project. Below that, point number 3. Next, what we are finding is, see, they have given profitability index 1.064. What is the formula for profitability index? Present value of cash inflow divided by present value of cash outflow. So here we know what is present value of cash outflow. We found that using IRR formula. So 1,14,200. And we know what is profitability index. What is profitability index? If you multiply both, you will get what is present value of cash inflow. This present value of cash inflow at IRR is different from present value of cash inflow, because this present value of cash inflow is at IRR percentage, whereas normal present value of cash inflow is different. So calculate it. Below that, point number 3. Point number 3. Calculation of present value of cash inflow at cost of capital. Understood? This present value of cash inflow is at IRR. When present value of cash inflow is at IRR, it will be equal to present value of cash outflow. So why we calculated using IRR percentage what is the present value of cash outflow, whereas present value of cash inflow at cost of capital will be different from the IRR percentage. So calculation of present value of cash inflow at cost of capital. Below that, PI is equal to, that is profitability index is equal to present value of cash inflow divided by present value of cash outflow. See, understand this. Present value of cash inflow at IRR is different from present value of cash inflow at cost of capital. We calculated using IRR what is present value of cash outflow, but present value of cash flow at IRR, present value of cash flow at cost of capital, everything will be same, because outflow we are doing it on the first day itself. So present value of cash outflow will be same, but inflow at IRR will be different and cost of capital will be different. So this IRR we are calculating using discounted cash flow method, whereas this cost of capital is calculated using what is the cost we are paying for that particular investment. So using that, you are calculating present value of cash inflow. Here we have profitability index value. So formula for profitability index is present value of cash inflow divided by present value of cash outflow. So below that record, present value of cash inflow at KO, that is cost of capital, present value of cash inflow at KO is equal to present value of cash outflow into PI. Present value of cash outflow into PI. Below that is equal to, what is the present value of cash outflow we have found? Present value of cash outflow into PI. So present value of cash outflow is 1,14,200. Below that record is equal to 1,14,200 into, so what is the present value of profitability index? 1.064 into 1.064. So we are getting 1,14,200 into 1.064, that is 1,21,509. 1,21,509, which is nothing but present value of cash inflow at cost of capital. So present value of cash inflow at cost of capital. So with that we have found what is present value of cash inflow at cost of capital and also present value of cash outflow. If you deduct both, you will get what is NPV. NPV formula is present value of cash inflow minus present value of cash outflow. Here we found what is the present value of cash inflow at cost of capital. That only you should use for NPV, because IRR present value is totally different. That IRR present value of cash inflow is only applicable for IRR, whereas this present value of cash inflow for cost of capital is only applicable for NPV. So below that, NPV is equal to, we found both present value of cash inflow at cost of capital and also present value of cash outflow. If you deduct both, you will get what is NPV. So NPV is equal to, below that, point number 4, net present value is equal to present value of cash inflow minus present value of cash outflow, which is equal to 1,21,509 minus 1,14,200 minus 1,14,200, which is equal to 7,309. So that is the net present value. So we have calculated what is cost of project, that is present value of cash outflow. Next we have calculated what is NPV. Now next one we should calculate is cost of capital. How can we calculate cost of capital? We can calculate cost of capital by using this present value of cash inflow at cost of capital. We know what is annual cost savings, that is annual CFAT. If you multiply that annual CFAT into annuity factor of a particular percentage, you will get what is the cost of capital, that is present value of cash inflow. Here we have present value of cash inflow and we have what is annual cost savings. So using that we can find what is the percentage of annuity factor. So below that, point number 5, calculation of cost of capital. Below that, present value of cash inflow at cost of capital is equal to present value of cash inflow at cost of capital is equal to annual CFAT into annuity factor. Here, because first take down the formula, annual CFAT into annuity factor at cost of capital. Here annual CFAT is same 40,000 and we know useful life is 4 years. So annuity factor for 4 years, something if you multiply with this 40,000, you will get this 1,21,509. We found this 1,21,509 using profitability index formula. So below that, what is present value of cash inflow at cost of capital? 1,21,509 is equal to 40,000 into, we don't know what is the percentage of cost of capital. So annuity factor at the rate of KO into annuity factor at the rate of KO. Because we don't know what is the percentage, we know what is the present value of cash inflow and we know what is the annual CFAT. So if you divide both, you will get what is the annuity factor. If you see that annuity factor in the annuity factor table, we can easily find what is the percentage of cost of capital. So if this annuity factor of KO, annuity factor at the rate of KO is equal to, if this come to the left hand side, it will become division. So 1,21,509 divided by 40,000. So 1 lakh present value factor, present value cash inflow is 1,21,509 divided by annual cash flow after tax is 40,000. So you are getting annuity factor at the rate of cost of capital is equal to 3.308. That is the factor. We know what is factor now. That is 3.38. Annuity factor at the rate of cost of capital is equal to 3.038. That is the factor. So if you check for this factor in 4 years, that is project life is 4 years. So for 4 years, if you check this in annuity factor, you will get what is the percentage of cost of capital. Just check where this 3.038 is coming. 3.038 is coming at 12%. So 12% is the cost of capital. Simple, very simple. While we are calculating NPV in one sum, we did that. For calculating present value of cash inflow, when every year CFAT is same, you just multiply that CFAT into what is the annuity factor of the cost of capital. So here we have what is present value of cash inflow already, and we know what is annual CFAT. We just don't know what is the annuity factor of cost of capital. So if you divide this both present value of cash inflow and the annuity factor of cost of capital, sorry, annuity of, if you divide the present value of cash inflow and the annual CFAT, you will get what is factor, that is annuity factor of cost of capital. And if you search for that factor in the factor table, that is annuity table, here is the 4 years annuity table for each percentage, that is 15, 14, 13, 12. If you check one by one, you are getting 3.038 at 12%. So below that record, annuity factor of 3.038, annuity factor of 3.038 is relatable to discounted factor of 12%, is relatable to discount factor of 12%. Hence KO is equal to 12%. Hence KO, that is cost of capital, is equal to 12%. So simple, I'll explain you one by one. Using IRR formula, that is present value of cash inflow at IRR is equal to present value of cash outflow. So at IRR percentage, both will be same. So using that, we found out what is the present value of cash outflow. Then using that present value of cash outflow in profitability index formula, we found out what is present value of cash inflow at cost of capital. Then using that both present value of cash inflow at cost of capital and present value of cash outflow, we found out what is NPV. Then using the present value of cash inflow at cost of capital, we found out what is the cost of capital percentage. These are the 5 different formulas we used. So next, what else they have asked? Only they have asked payback period. So one more thing that they have asked is payback period. Just take down. Below that, point number 6, payback period is equal to total investment divided by annual CFAT. Total investment divided by annual CFAT. What is the total investment? Total investment is nothing but present value of cash outflow. That is, how much is the total cash outflow? That is the total investment. So 1,14,200. We calculated what is present value of cash outflow. So 1,14,200 divided by what is the annual CFAT? Annual CFAT is 40,000. So 1,14,200 divided by 40,000. That is equal to 2.86 years. If you divide both, you are getting 2.86 years. That is the payback period. With that, we have calculated all 4 values. And also we have calculated what is the present value of cash inflow. So with that, we have completed problem number 9. This problem number 9 and all, if you keep working out, you will just come to know what is the concept they have given. So problem number 9, just keep working out. Every time you go through this chapter, just work out this problem 9 kind of sum and all, just work out. So with that, we have completed problem number 9. So moving on to we have already completed problem number 8, right? No, we didn't complete problem number 8. So moving on to problem number 8. So problem number 8, what they have given, BFP Limited is considering the okay, this is one important sum. So take down. First read the question. Problem number 8. BFB Limited is considering the purchase of delivery van. Okay, it's considering the purchase of delivery van and is evaluating the following 2 choices. So there are 2 choices. You have to evaluate both and tell what is the best choice. Which one is the best choice? So below that, point number A, the company can buy a used van for 20,000 rupees and after 4 years sell the same for 2,500. Scrap is 2,500 and today you are going to purchase it for 20,000, that is cash outflow. Both are net of taxes, and replace it with another used van which is expected to cost 30,000. So after 4 years you are going to again expend 30,000 rupees. That is, at the end of 4 years you are going to spend 30,000 rupees for new van, that is another van, and that van has a 6 years life with no terminating value. So that 30,000 rupees new van from at the end of 4th year, that is for next 6 years you can use it and there will be no terminating value for that van. So that is the option 1. For this, you should calculate what is the NPV, that is present value of cash inflow, and or you should calculate what is the present value of cash outflow. There is only outflows here. So comparatively, where the present value of cash outflow is lesser, you should accept it. So first option is, see, understand the option. First option I will clearly explain you. You are doing this transporting business. What is your first option is to purchase a used van today and use it for next 4 years, and at the end of 4 years sell that used van for 2,500 rupees and purchase another van for 30,000 rupees at the end of 4th year. So at the end of 4th year again you are spending 30,000 rupees. So use the 30,000 rupees van for next 6 years, and at the end of 10th year that van will also get demolished, that is it will go absolute and there will be no terminating value for that van. So that is the option 1. First purchase a used van, use that for 4 years. Then at the end of 4 years, purchase another van and use it for next 6 years. That is option 1. So next option 2, the company can buy a new van. Option 2 is a company can buy a new van. The projected life of the van is 10 years. So you can use only one van for 10 years and as an expected salvage value of 5,000 rupees. So the scrap value is 5,000. At the end of 10th year, you will be receiving 5,000 rupees by selling that van. So the services provided by the van under both the choices are same. So whatever the service cost which you are doing, whatever the oil change, whatever the service cost which you are doing, it will be the same for both the options. So you don't have to evaluate that service charges. Assuming the cost of capital is 10%. So they have given cost of capital 10%. So for calculating present value, you should use the present value factor at the rate of 10%. Which choice is preferable? So first option, purchase a old van, use it for 4 years, sell it for 2,500, again purchase another van for 30,000 and use it for 6 years. So that is the option 1. And option 2, purchase a new van today itself and use it for 10 years. That new van cost 40,000 and at the end of 10 years you are getting back 5,000 rupees as scrap value. So these are the two options. So you should calculate what is the present value of cash outflow under both the options, and wherever the present value of cash outflow is less, then that option is acceptable. So take down. Now you have understood the question. You are evaluating both the options. Both the options are total present value of cash outflow. So below that, problem number 4. Next problem, take down. Sorry, problem number 8. Problem number 8. Below that, statement number 1. Statement 1. Calculation of present value of cash outflow. Calculation of present value of cash outflow under vehicle option, under used vehicle option. So first option is used vehicle option. Under used vehicle option. See, simple. First option is used vehicle option. Second option is new vehicle option. So both the options you should calculate what is the total cash outflow. That is present value of cash outflow. Just you should multiply what is the cash outflow and present value as on the date of spendings. That is as on the date of outflow, what is the present value factor. You should multiply it so that you can bring the total value to the present value of cash outflow and then compare both the present value of cash outflows. Wherever the cash outflows is less, that option is acceptable. So below that, 2 columnar table. Important sum this is. Just mark it as important. 2 columnar table. First column particulars, second column amount. First column particulars and second column amount. Below that particulars, record small a. What is the first outflow that we are doing? The company can buy a used van for 20,000 today. That is 20,000 you can buy today. So 20,000 rupees you are expending today. So small a, present value of purchase price of used van. Present value of purchase price of first used van. First used van 20,000 rupees you are spending today. So present value of purchase price of first used van. Below that, 20,000 rupees is the cost. So 20,000 rupees within bracket 20,000 rupees into what is the present value factor for today? It is 1. So into 1. So within bracket 20,000 into 1. Amount column record 20,000. Amount column record 20,000. In respect of the small a, record 20,000. Below that small b. Below that small b. See, after 4 years, you are selling the same for 2,500 rupees. When you are selling, cash is coming in, right? See, when you are purchasing for 20,000 rupees, your cash is going out. So it is an outflow. And when you are selling it after 4 years, you are receiving back 2,500 rupees, which is cash inflow. So from this 20,000 rupees, you should deduct the 2,500 rupees of present value. So 2,500 rupees you are going to receive at the end of 4 years. So you should convert the 2,500 into today's value, that is present value, and you should multiply it with the present value factor 2,500 rupees, and you should deduct it from the 20,000 rupees. So that is the beauty of this cash inflow. Whenever there is cash inflow, you should deduct from the cash outflow, so that you can evaluate what is the present value of net cash outflow. So below that small b, present value of scrap, at the end of 4th year. At the end of 4th year. So present value of scrap at the end of 4th year. So at the end of 4th year, for how much you are spending? for how much you are giving it back? 2500. So you are receiving 2500 rupees. So below that, within bracket, 2500 into, see, simple, for 4 years, at the end of 4th year you are receiving 2500. So what is the present value factor at the end of 4th year? You should see. You can either do it using calculator, that is 1 divided by, what is the cost of capital here? 10%. So 1 divided by 1.10. You are getting for the first year 0.909, second year 0.826, third year 0.751, and fourth year 0.683. So for the 4th year you are getting 0.683. So you can multiply this 2500 into 0.683, because at the end of 4th year you are receiving 2500. So the value of 2500 at the end of 4th year is 2500. But today, what is its value? You can calculate it by multiplying with the present value factor at the rate of 10% for 4 years. So present value factor at the rate of 10% for the 4th year is 0.683. So 2000 within, below that, within bracket, 2500 into 0.683 into 0.683. Amount column record within bracket 1707.5, 1007.5 within bracket. See, simple. Present value factor of the scrap you are detecting, that is beginning of the year, that is at the present day, that is at the date of planning for purchase of van, you are expending 20,000, and when you are reselling it to the some other person, you are receiving 2500. So normally, if you are not taking into consideration this present value factors, what you will do? 20,000 purchase cost minus scrap value, that is the net purchase cost. So instead of doing that, while calculating present values, 20,000 you are spending today, so 20,000 into 1, and 2,500 you are receiving at the end of 4th year, so 2,500 into 0.683. So you should deduct this 2,500 into 0.683 from this 20,000. So you will get that net purchase cost. You understood now? No? So that is called net purchase cost. So deduct it 1707.5. Again, after reselling it on at the end of 4th year, again at the end of 4th year you are replacing it with another used van, which is expected to cost 30,000 and has 6 years life with no terminating value. See, you are going to replace the machine at the end of 4th year when you are reselling the first machine. So first van you are selling it, first used van you are selling it at the end of 4th year, and replacing it at the end of 4th year itself with another used van that costs 30,000. So at the end of 4th year, again you are spending 30,000 rupees for second used van. So at the end of 4th year, value is 30,000. So what is the present value for it? That you should calculate. So below that, small c, present value of purchase price, present value of purchase price of second used van. Second used van. So you are spending 30,000 rupees at the end of 4th year again. So at the end of 4th year, what is the present value? 1 divided by 1.1. That is for first year 0.909, again press equal to, you will get for second year 0.826, press equal to, you will get 0.751 for third year, and for 4th year 0.683. 0.683. So below that, record within bracket 30,000 into 0.683. So you are spending 30,000 at the end of 4th year. So what is the present value for that? You should calculate 30,000 into 0.683. 0.683. What you are getting? So present value of that cost which is going to be incurred for second van is 20,490. So at the end of 4th year, you are going to spend 30,000. So that 30,000 today's value is 20,490. So that is value spent, that is cost incurred. So that should be added. So in respect of amount column record 20,490. So total for you are incurring outflow of 20,000 and 20,490, that is present values. And at the end of 4th year, you are getting scrap of 2,500 rupees. For that value is 1707.5, which you should deduct it. So now total it. Now total the amount column, you are getting 38,782. 38,782. In respect of the 38,782, record present value of cash outflow. In respect of the 38,782, record present value of cash outflow. Present value of cash outflow. Done. That is the present value of cash outflow under used vehicle option. Below that, statement number 2. Below that, statement number 2. Calculation of present value of cash outflow under new vehicle option. Calculation of present value of cash outflow under new vehicle option. Under new vehicle option. Below that, 2 columnar table. Below that, two columnar table. First column particulars, second column amount. Below the two columnar table, first column particulars, second column amount. So we are going to calculate what is the present value of cash outflow for the new vehicle. Here for new vehicle, today you are spending 40,000 rupees. At the end of year 10, you are receiving back 5,000 rupees. So 40,000 into 1 and 5,000 into present value factor of at the rate of 10% for 10th year. That you should multiply, because at the end of 10th year only you are getting 5,000. So into 10th year present value factor at the rate of 10%, if you multiply, you will get what is the present value of cash inflow. So if you deduct from the 40,000, you will get what is the present value of cash outflow. So below that particulars record small a, two columnar table particulars and amount. Below that particulars record small a, present value of purchase price of new van. Present value of purchase price of new van. Below that, within bracket, how much is the purchase price of the van? 40,000. You are spending 40,000 rupees today. So 40,000 into 1, because today's value is 1 rupee. So within bracket 40,000 into 1, amount column record 40,000. Amount column record 40,000. Below that small b, minus present value of scrap value at the end of 10th year, because you are receiving 5,000 back as scrap value. That is, when you are selling the machine, you are receiving back 5,000 rupees. So that 5,000 rupees is a cash inflow. So you should deduct it from the, once again. So sorry, I got a call. We are doing this second statement, that is calculation of present value of cash outflow under new vehicle. So basically this purchase of under this new vehicle, we are purchasing vehicle today 40,000 rupees and we are expending 5,000 rupees, like we are receiving back 5,000 rupees at the end of 10th year. So 40,000 rupees into 1, that is 40,000 present value of purchase of new van, whereas small b minus present value of scrap value at the end of the 10th year. So at the end of the 10th year, the value for 10% is 0.386. Just you can calculate it by dividing 1 divided by 1.10 plus equal to, that is for first year 0.909, second time, third, fourth, fifth, sixth, seventh, eighth, ninth, 10th. 10 times if you press the equal to button, you are getting 0.386. So 0.386 is the present value factor at the rate of 10% for the 10th year. So within bracket below that, 5,000 into 0.386. Within bracket 5,000 into 0.386, amount column you are getting 1910 within bracket. 1910 within bracket. So now total it. 40,000 minus 1910. 1910 is the 5,000 which you are receiving at the end of 10th year present value. So 40,000 minus 1910, you are getting 30,070. 38,070. In respect of the 38,070, record present value of cash outflow. Present value of cash outflow. So present value of cash outflow under new old vehicle option, that is second hand vehicle option, is 38,782, whereas under new vehicle option is 38,070. So under new vehicle option it is lower. So below that comment, present value of cash outflows are comparatively lower under option 2, hence it is advisable to purchase new van. So with that, we have completed problem number 8. Moving on to problem number 11. See here, problem number 11, they have given calculate base case NPV. So this base case NPV, just strike out this problem number 11. Strike out this problem number 11. Strike this problem number 1. It is cancelled. So I'll give you another next to that, right? Problem number 11 change. I'll just give you the question of another problem, so that you can have it as problem number 11. So moving on to problem number 7. Okay, we'll just finish off this problem number 7 now. So RAM Limited, once again. Okay, first we'll read the question. R Limited specialize in the manufacturing of novel transistors. They have recently developed technology to design a new radiator transistor capable of being used as an emergency lamp also. So R Limited is manufacturing novel transistors and they are producing new radio transistor which is used for emergency lamp. So they are quite confident of selling 8,000 units. So number of units to be sold, output is 8,000 units, and that would be making in a year the capital equipment 8,000 units that they would be making in a year. So total output is 8,000 units. The capital equipment that would be required will cost 25 lakhs. So capital investment amount is 25 lakhs. It will have an economic life of 4 years. So 25 lakhs and economic life is 4 years and has no significant terminal salvage value. So 25 lakhs divided by 4 will be the depreciation. So next, during each of the first 4 years, promotional expenses are planned as under. So first year, advertisement 1 lakh, others 50,000. Second year, advertisement 75,000, others 75,000. So every year, the total other expenses, that is promotional expenses, will be 1,50,000. If you calculate what is the total expenses under every year, it will be 1,50,000. Apart from that, variable cost of production and selling expenses is 250 per unit. So the variable cost is 250 per unit. Fixed cost is this capital equipment cost. So you should divide it by 8,000 units. Then other expenses also they have given. Additional fixed operating costs incurred because of this new product are budgeted at 75,000. Apart from all these costs, 75,000 per year is the additional fixed cost. Below that, the company's profit goals call for discounted rate of return 15%. So rate of return, that is cost of capital, is 15% after tax investment on new products. The income tax rate at an average of workouts at 40%. So income tax rate is 40%. Okay, income tax rate is 40%, whereas discounted rate of return is 15%. That is cost of capital. You can assume that straight line method of depreciation will be, see here they have given the company's profit goals call for discounted rate of return. Discounted rate of return is nothing but IRR. Okay, discounted rate of return means IRR. Normal rate of return or cost of capital means that is cost of capital. So your discounted rate of return should be taken as IRR. Below that, assume that the straight line method of depreciation will be used for tax and reporting. So 25 lakhs divided by 4. Next, work out an initial selling price per unit of the product that may be fixed for obtaining desired rate of investment. So they are asking us to calculate what is the selling price per unit of the product that can be fixed by obtaining desired rate of return on investment. Here discounted rate of return is 15%. So under discounted rate of return, that is IRR, present value of cash outflow will be the present value of cash inflow at IRR. We have solved that sum. So at this discounted rate of return is nothing but IRR. So at IRR, both present value of cash inflow at IRR will be equal to present value of cash outflow. So here we can easily calculate what is present value of cash outflow. On that, if you multiply with the discounted rate of return, we'll get what is present value of cash inflow, that is discounted cash inflow IRR. By that we can calculate what is the selling price per unit. Below that, they have given present value of annuity of 1 rupee received or paid in steady stream throughout the year is future 15%. So they have given discounted rate of return 15%, that is IRR. So here we should calculate IRR at 15%. For IRR at 15% for 4 years, annuity factor is 3.0079. They have given annuity factor for 15% for 4 years, that is 3.0079. So now with this we should calculate what they have asked us to calculate. We should calculate what is selling price per unit. Ultimately we should add up all the cost, that is if you add all the cost you will get what is the total cost outflow. From the total cost outflow, if you convert that into present value of cash outflow, that is called present value of cash inflow at IRR. So at IRR, by multiplying present value of cash inflow, you can easily get what is the selling price per unit. So below that, now next problem, put the heading problem number 7. Next, put the heading problem number 7. Below that, point number 1. Let's assume selling price per unit is equal to X. Selling price per unit is equal to X. So we are assuming selling price per unit is X. So if you multiply that X with this 8,000, you will get total output, total sales value, that is 8,000X. So below that, point number 2, calculation of present value of cash inflow. Calculation of present value of cash inflow. How much is the present value of cash inflow? Total output minus whatever the cost, you will get what is the present value of cash inflow. So simple. Below that present value of cash inflow, put 2 column in a table. First column particulars, second column amount. First column particulars, second column amount. First you should multiply sales value, then sales value minus total cost, you will get PBT. From the PBT, if you take off tax, you will get PAT. From the tax, if you add depreciation, you will get CFAT. On the CFAT, if you multiply with the annuity factor, you will get present value of cash inflow at IRR. Okay, one by one we'll do. Below that particular record, small a, annual sales value within bracket, annual sales value within bracket, how many number of units is being sold? 8,000 units. What is the selling price per unit? We have assumed X. So within bracket 8,000 into X, 8,000 into X, amount column record 8,000 X, amount column record 8,000 X. Below that small b, total cost, underline it. What are the different costs incurred they have given? So we should take one by one. Below that first arrow mark, variable cost of production and selling expenses. First arrow mark, variable cost of production and selling expenses. How much is the selling production and selling expenses? They have given 250 per unit. So total 8,000 units into 250 per unit, you will get total variable cost of production and selling expenses. So within bracket, just below that, take down within bracket 8,000 into 250. 8,000 into 250. How much is your value you are getting? 8,000 into 250, that is 20 lakhs. So in respect of amount column record 20 lakhs. Amount column record 20 lakhs. Then below that second arrow mark, advertising and other costs. Advertising and other costs. See, if advertising and other cost is different for every year, then we should do separate calculation for the advertising and other cost for every year. That is, we should calculate what is the total cost. On that, you should divide into 4 years. Each 4 year total cost, other total cost plus advertisement cost, you will get total cost. So you should do like that. Here, advertisement cost and other costs are same as a total for every year. 1 lakh plus 50,000, you are getting 1 lakh 50,000. 75,000 plus 50,000, 75 plus 75, you are getting 1 lakh 50,000. 60 plus 90, you are getting 1 lakh 50. 30 plus 1 lakh 20, you are getting 1 lakh 50. So all the years it is common that 1 lakh 50,000. So second arrow mark, advertising and other costs. Advertising and other costs. Amount column record 1 lakh 50,000. Amount column record 1 lakh 50,000. Advertising and other costs, amount column record 1 lakh 50,000. And below that, see, they have given additional point, that is additional fixed operating costs incurred because of the new product are budgeted at 75,000 per year. So every year budgeted fixed cost is 75,000. So put an arrow mark. Put an arrow mark. Fixed cost. Fixed cost in respect of amount column record 75,000. In respect of amount column record 75,000. Apart from this, there is one more cost, that is depreciation. So depreciation, they have given, assume that the straight line method of depreciation will be used for taxing and reporting. So straight line method 25 lakhs divided by 4. So second last arrow mark, below that last arrow mark, depreciation per annum. Depreciation per annum within bracket 25 lakhs divided by 4. 25 lakhs divided by 4. Amount column record 6 lakh 25,000. How much is 25 divided by 4? You are getting 6.25, that is 6 lakh 25,000. Amount column record 6 lakh 25,000. So now total cost, total it. Total cost alone, total it 20 lakhs plus 1 lakh 50 plus 75,000 plus 6 lakh 25,000. 20 lakhs plus 1 lakh 50,000 plus 75,000 plus 6 lakh 25,000. You are getting 28 lakh 50,000. Amount column, total it 28 lakh 50,000. In respect of the 28 lakh 50,000 record, therefore total cost. Therefore total cost. Total cost. Below that small c. Below that small c. Profit before tax. Profit before tax. So here interest element is not there. They have not given any interest, so interest is not there. Other costs we have deducted, including depreciation. So that is PBT. Small c within bracket, small c PBT within bracket A minus B. A minus B. So what is A minus B here? 8,000 X minus 28 lakh 50,000. So in respect of C column, amount column record 8,000 X minus 28 lakh 50,000. 8,000 X minus 28 lakh 50,000. 28 lakh 50,000. So that is profit before tax. So here tax amount is 40%. That is income tax on an average works out at 40%. So deduct 40% from this. So below that small d, minus tax at the rate of 40%. Tax at the rate of 40%. So just calculate what is the 40% of it. So 8,000 X into 40%, that is 3,200 X. Amount column record 3,200 X minus, what is this, 28 lakh 50,000 into 40%? You are getting 11 lakh 40. So minus 11,40,000. So 3,200x minus 11,40,000. 3,200x minus 11,40,000 is the tax amount. So if you deduct this from the PBT, you will get what is PAT. Now underline it. 8,000x minus 3,200x. You are getting 4,800. 8,000 minus 3,200x. You are getting 4,800x. 4,800x. Below that record 4,800x minus 28,50,000 minus 11,40,000. You are getting 17,10,000 minus 17,10,000. So 4,800x minus 17,10,000 is the profit after tax. So in respect of that 4,800x minus 17,10,000, record small e profit after tax. If tax amount is 60%, profit after tax is profit amount here 40%. See, PBT from the tax amount is 40%. So remaining is the profit after tax, that is 60%. You can even directly calculate profit after tax at the rate of 60%. So PBT into 60%, you will get this 4,800x minus 17,10,000. So this is profit after tax. On that, if you add depreciation, you will get what is CFAT. So below that small f, add depreciation. How much is the depreciation we calculated in total cost? 6,25,000. So add it. In respect of amount column, record 6,25,000. Small f, add depreciation, amount column, record 6,25,000. Now total it. 4,800x. Below that record, underline it, below that record 4,800x. Here minus 17,10,000 plus 6,25,000. You are getting minus 10,80,000. So minus 17,10,000 plus 6,25,000. You are getting minus 10,85,000. So below that underline and record 4,800x minus 10,85,000. Minus 10,85,000. This is nothing but CFAT. So in respect of that record, therefore CFAT. Small g, therefore CFAT. So we have found CFAT 4,800x minus 10,85,000. If you multiply CFAT with annuity factor of 15% at the rate of 15% for 4 years, that is 3.0079, then you will get what is the present value of cash inflows at IRR. You will get what is the present value of cash inflows at IRR. So simple. Whatever is the, here they have directly given discounted rate of return. Discounted rate of return, just underline it. Above that, right, take down. It is nothing but IRR. Discounted means present value factor has been multiplied with that value, so it is discounted. So when you are using present value factors and finding what is the rate of return, that is nothing but IRR, internal rate of return. So here below that CFAT record small h, you should multiply CFAT with the annuity factor at the rate of 15% for 1 to 4 years. So annuity factor small h, annuity factor at 15% for 4 years. Annuity factor at 15% for 4 years. So what they have given for 4 years at 15%, what is the annuity factor? It is 3.0079. So in respect of amount column, record 3.0079. 3.0079. Below that, now multiply it. CFAT into annuity factor, you will get present value of cash inflows at IRR. So below that small I, sorry j, below that small j, small I, present value of cash inflows, at IRR. Present value of cash inflows at IRR, because at IRR percentage we are calculating. IRR percentage given is 15%. So at IRR, what is the present value of cash inflows? Now multiply both. Below that, within bracket, G into H. Within bracket, record G into H. Now amount column, total it. 4,800x into 3.0049. Sorry, 49. You are getting 3.0079. 4,800x into 3.0079. You are getting 14,437 point, that is 437.9, that is 14,438x. 14,438x. Then 10,85,000 into minus 10,85,000 into 3.0079. 10,85,000 minus 10,85,000 into 3.0079. You are getting 32,63,571 minus, next to that 14,438x record minus 32,63,571. So you are just multiplying CFAT with the annuity factor so that you will get what is the equation for present value of cash inflows at IRR. So 14,438x minus 32,63,571. 32,63,571. That is the present value of cash inflows at IRR. So now this present value of cash inflows at IRR is equal to the present value of cash outflow, that is 25 lakhs. We know that at IRR, both present value of cash inflow at IRR and the present value of cash outflow will be equal. So using that, we can easily find what is the selling price per unit. So below that, statement number 3, that is point number 3, calculation of selling price per unit. Calculation of selling price per unit. Below that, put an arrow mark. At IRR, present value of cash inflows will be equal to present value of cash outflows. At IRR, present value of cash inflows is equal to present value of cash outflows. So we know what is present value of cash inflows, that is 14,438x minus 32,63,571. So take it down. 14,438x minus 32,63,571. 32,63,571 is equal to what is the present value of cash outflows, that is 25 lakhs. They have directly given the capital equipment that will be required will cost 25 lakhs. So cost outflow is 25 lakhs. So is equal to present value of cash outflow is equal to 25 lakhs. So now solve this equation, you will get what is X. X is nothing but selling price per unit. So if this 32 lakhs goes to the left hand side, it will become addition. So 32,63,571 plus 25 lakhs, you are getting 57,63,571. So below that X is equal to 57,63,571 divided by 14,438 divided by 14,438. You are getting X is equal to 399.19. X is equal to 399.19. So we have found X 399.19, that is nothing but selling price. So therefore selling price per unit is equal to selling price per unit is equal to 399.19. That is 399 rupees 19 paisa is the selling price per unit. If you work out at IRR 15%, what is the present value of cash inflows? So selling price per unit is equal to 399.19. Below that, record comment. If RAM Limited requires 15% return on investment, then it has to fix a selling price. Of rupees 400 per unit. So simple. Here they have given what are all the different costs, and they have given what is the selling price sales value. By multiplying 8,000 into X, we can find what is the sales value. So when deducting both, we will get what is PBT. From the tax, take it off, then PAT. From that add on that add depreciation, you will get CFAT. Multiply it with the annuity factor at the rate of 15% for 4 years, because here the internal rate of return IRR given is 15%. So at IRR, you know that present value of cash inflow at IRR is equal to present value of cash outflow. So using that formula, you can easily find what is the X, that is selling price per unit. So that is what problem number 7. So with that, we have completed problem number 7. Till now we have completed 1, 2, 3, 4, 5, 6 problems. 6 and 1 problem has been cancelled. 7 is over. Okay, fine. We'll see the remaining sums in the next video. Thank you.